This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Tesla's about to do the unthinkable. And I want you to see the position Tesla's in, and what they're going to have to do is not just going to affect the U.S. automotive sector, it's going to affect the broad U.S. economy as a whole. And as you're about to see, they're not the only ones. Companies around the world are going to be facing the same problem. In fact, we're seeing it in the world's second largest economy, as the government there now has stepped in to do what nobody thought would happen. And to make matters worse for them, as I'm going to show you, the United States has just made a move that could tip their entire economy and the rest of the world into recession. Now let's head over to CNBC, where we picked today's story up with a headline: as Tesla layoffs continue. Here are 600 jobs the company cut in California, and we continue to hear from the Federal Reserve that they want to see a softening in the labor market. The problem now we're seeing is companies are laying off, and they're starting to lay off and even more. And this is a huge issue because what's facing Tesla is an underlying issue. We'll look at that in a moment, as the cuts reported in a Worker Adjustment and Retraining Notification Act. And what we're seeing is facing both weakening demand for Tesla electric vehicles and increased competition. The company has been slashing its headcount since at least January. And so what we're seeing now in the manufacturing sector is we had too much demand and not enough supply. Now we're seeing just the opposite, where supply is starting to get out of hand, and that's going to force Tesla and other companies to do the unthinkable. Elon Musk told employees in a memo in April that the company would cut now more than 10% of its global workforce, as previous filings revealed that Tesla would cut more than 6,300 jobs across California, Texas, and New York. And we can see why. It's because Tesla is facing reduced demands for its cars that it makes in Fremont, including its older Model S and X vehicles, along with its Model 3 sedan. Total deliveries dropped in the first quarter from a year earlier, as Tesla reported its steepest year-over-year revenue decline since 2012. Now, what's interesting is when we look at market cap weighted indices, obviously Tesla's a big player here, but investors continue to cram in to the top Magnificent Seven stocks, believing that everybody's immune here. And what we're seeing from one of the world's largest automakers is a huge issue. That demand now has suddenly evaporated, and this means other companies, not just them, all around the world in many different sectors, are about to face the same issue. And onslaught of competition, especially in China, has continued to pressure Tesla's sales in the second quarter. Here we can see new models coming from competitors, which undercut the price of Tesla's most popular vehicles, forcing them to soon do what we're saying is the unthinkable. And part of the problem here has to do with the moves of the Federal Reserve. Because you think back, and what did we hear from Fed Chair Jerome Powell? That demand was too high, that he wanted to bring demand back. And in a business world, that makes absolutely no sense. If a business has too much demand, then what they should do is increase supply. But of course, obviously the Fed has no way to do that. So what they've done is they've restrained the economy in such a way that it even starts to backfeed down to the consumer level, because when you constrict credit, well, sure enough, people can't borrow, they can't borrow, they can't buy, and that's what we're seeing here in the automotive sector. As we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes, and what you see is on net tightening anytime between that blue lines above that horizontal black line. And we're going to look at total vehicle sales in terms of millions of units. And what you can see is anytime banks start to tighten standards, what happens with a lag, you'll note that vehicle sales start to decline. But there was plenty of demand going back in the dot-com era, that it remained relatively high. But look what happened in the global financial crisis. The sales just outright plummeted. And now what we see post-pandemic, there was an initial surge that's rolling over because the economy is changing as well. And this is on the back of a fundamental underlying problem that Tesla's facing. Because on the front side, we see, well, they're just cutting some staff a little bit. But the reason why, and the reason we're seeing this not just at Tesla, but in China as a whole, has to do with inventory. As thousands of more Teslas are piling up in parking lots, as Tesla's growing inventory can sometimes be seen, if you can believe this, from space. What's the problem here? Well, the problem is they have not enough buyers. They need, of course, more people coming in and buying their products. But one thing we're seeing piling up in the accounts of our subscribers, more money. Here you can see this is looking back over 2 months of tracking every initial trade per week from our subscriptions. You want to make money trading. You want to just know where the market cycles are. You want to know when to be in stocks, when to be in commodities, when to be in bonds. We show you the moves. Look at this CTA Timer Pro. You bought everything. You have a 90% win rate. Momentum Timer Pro, 88%. And look, you don't have to look at stock charts. You don't have to be a market timer. We show you how to do it. What's the difference? Well, we like to look at machine positioning. When they get in deep short positions and price starts to rally against them, our report flags it. We give you a video showing you how we think you should trade it, what my thoughts are, and even where to put your stop loss levels are. And then maybe you like to trade the technicals, all those things like the RSI and the MACD, but you find yourself getting in laid out early and bouncing all over the place. But we run a proprietary overlay, smooth all those signals out. We show you on the reports our high value signals, when to get in. We back it up with the video, and even here's the best part: you can make money too, and you don't have to be an expert. All you have to do is sign up. You get a 30-day free trial. My friends make you pay, and well, that's something, of course, Tesla may have to do too, is give people a free trial, because the roughly 400 Tesla EVs that are sitting in the parking lot at a shuttered mall outside St. Louis, Missouri, might have just been the tip of the inventory iceberg. But really, upon deeper inspection, it's far worse than that. In the last quarter, Tesla had an excess inventory of 46,561 vehicles sitting unsold. That's about 10% of its total production. So this is notable because you remember back during the pandemic and right after that, what did we hear? There just isn't enough supply, and that drove prices and inflation higher. Now all of a sudden what we're seeing is demand has been so restrained that supply has come back in such a huge way that we have the opposite problem: companies piling up inventory. And by contrast, the company has had an excess of approximately 2% for 2023 in its entirety. So it's clear that these yet to be sold cars have to be stored, well, somewhere. And that somewhere parking lots and all kinds of assuming places. But the issue isn't just with Tesla, and that's the whole point. In February, the latest month for which you have access to relevant data, the available inventory of EVs in the U.S. measured in days was 136 days. This figure excludes Tesla and Rivian, who sell their cars directly to consumers, but compared to the industry average of 78 days, the picture isn't rosy as well. And so what do you see here is demand going away. But I'd love to know, where are you at? Are you looking to buy a car right now? Are you waiting for some steep discounts? Because the unthinkable move that Tesla's going to have to do is get into a price war with itself, and they're going to have to drive prices down. This is going to create, of course, opportunity, and what it's going to do is backfeed across the global auto manufacturing sectors. Everybody with inventory is going to start cutting prices, and you think about what this means for inflation, because I also want to know, many people have said inflation's going to roar back. Based on this, are you changing your mind? Because let me give you some more data. As we look at capacity utilization, and this is an issue that Tesla is going to face, because when you have a factory, you run the production line, and now all of a sudden what happens when you get too much inventory you can't sell? You have to throttle back production. And one thing else you throttle back with that, well, as you're about to see, is going to be inflation, as of course Tesla looks to cut prices as their competitors do, but also labor. And here you can see capacity utilization against the consumer price index. Consumer price index shown in red on a year-over-year rate of change, and you can see as the percentage of a factory's utilization drops, which makes sense as demand goes down and there's too much supply, what happens to inflation? It follows it lower. Here you can see the Fed worried that inflation is going to come back. Many consumers saying, look, this is the 1970s. Steve, you can't see it, but this pullback here, well, it's coming to come back again and again. But based on what we're seeing here at the factory level, at least with Tesla and other companies right now, is suggesting that's not likely at all. And then we started the show with Tesla laying off another 600 people. Well, when factories start to find themselves overproducing with too much inventory, Well, that means you throttle back the production line and you throttle back the number of employees. Here you can see capacity utilization against continued unemployment claims. That's shown in red. Anytime you see a downward move in capacity utilization, well, that means more and more people hit the unemployment line, just like Tesla is doing. And what we can now expect, just based on the little bit of data we have here, that we're going to see capacity utilization, not just in the US, but all around the world, start to dry up. And that means more and more people hit the unemployment line. And that's notable because we're going to see this affect companies all around the world. And it's gotten so bad that in China, well, the government has stepped in a big way. We couldn't predict this was happening, but we did say the government was going to have to jump in. Here, the PBOC earmarks a whopping $42 billion for state buying. This is important. State buying of unsold homes. Can you imagine if this happened in the U.S., if the government stepped in and said, hey, Tesla, don't worry, we're going to come in and buy up all your excess inventory? People would go crazy, but in China, they can get away with this, as a central bank deputy governor announced the so-called relending program at a brief in Beijing on Friday, hours after the government unveiled an unprecedented package of measures to address the nation's protracted property crisis. So again, we see this now all around the world. We didn't have enough supply. Now all of a sudden we're starting to see too much of it, and everyone's still buying into the narrative of the soft landing and no landing. So what that means, they're still running their factories too hot. Too much inventory is going to hit the market the second half this year, as funding will be extended to 21 providers, including policy banks, state-owned commercial lenders, and joint stock banks at a rate of 1.75%. The loan's designed to have a one-year term, and get this, they'll be allowed to be rolled over 4 times. So they're not even confident their own program's going to work, because the only thing, if you knew it was going to work, you will say, well, hey, you have 1 year, but no, they're going to roll it over 4 more times. As lenders in the new program will be encouraged to extend financing to regional state-owned enterprises, handpicked, this of course, by local governments to support their purchase of unsold finished homes at, of course, what must be reasonable prices, because they know that their property developers are hemorrhaging. But it's not just about the developers. This is about the broad economy, because when you start having too much inventory, that means prices start coming down, and that means, of course, people hit the unemployment line, which in turn drives prices down. But in China's case, it's worse, because direct contribution to the property sector to China's GDP, well, here you see the housing market, and what that suggests is China's not going to hit their growth targets by a mile. In fact, what it suggests is our economy is going to hit a recession. And I want you to think about what the U.S. just did. Of course, the Biden administration now has come out with new tariffs starting this year that will be added on in 2025, 2026. And this is a huge issue for, of course, the world's largest exporter, as China's home prices now fall at a faster pace despite revival efforts. So you see what's coming in the automobile space here, as policymakers are accelerating efforts to revive demand for homes and will address a glut in supply. Worries over residential values, which is a good point, because people don't tend to buy when prices are falling, at least on homes. Unfinished apartments and job security are deterring buyers. But you note the word job security, and this is key here, because why would people be worried about their jobs if the global economy is booming? The answer is it's not, and that's what they're seeing in China, is the government is forcing production in the factories because there isn't demand from the rest of the world, and that means people are wondering how long can Beijing prop their own economy up, and this is leading to a prolonging a property slowdown that's dragging on the world's, of course, second largest economy. Prices are expected to drop over the next few quarters as more homeowners list existing properties to take advantage of new policies such as lower mortgage rates and down payments. So on the top of the fact that there's unsold brand new homes, well, existing buyers are saying, look, I need to get out of this payments, get my money out of this property, because things are getting worse. And from a year earlier, new home prices fell 3.51% in April, steeper than March's 2.7% drop. Existing home prices dropped 6.79%, both record declines since the Bureau began the current method of collecting data this back in 2011. And here you can see, at least in the U.S., we come back to central bankers keeping monetary policy too tight. And what this suggests is that PBOC is going to have to lower rates, but they don't want to because, well, they're afraid the yuan is going to crash to, well, nothing. And that's an issue because all they need is the Fed to cut, and then you start tacking on, of course, more tariffs. You see it is all but a foregone conclusion that we're going to see China's economy hit a recession, probably something much worse. We come back to the net percentage of domestic banks tightening standards to firms of all sizes against all transaction house prices here in the United States. And what do you see is, again, this is on a year-over-year rate of change. You note that when banks tighten standards, the year-over-year rate of change comes down. But again, the economy and demand for housing and cars was fairly good back during the dot-com bubble. But look what happens during the global financial crisis. You get a contraction in home prices, and now we're seeing them slow down. What this is suggesting is we're likely to see an oversupply in the housing market as well. And China's bet on manufacturing ups risk from trade battle with the U.S. So China's solution to their problem is, hey, let's just crank the factories up and produce a bunch of stuff, dump it on the rest of the world, and that'll work. Well, that is until everyone gets wise to that move and says, you know what, China, we've got some tariffs for you. The trade frictions will make the sustainability of this export-driven recovery model very problematic. So you start to understand the perspective here is by putting on these tariffs, you, the United States, we are potentially going to be the tipping point for China to drive them into recession. That would be a wild thing if it happens, but it looks like it's going to. At the end of the day, China has to boost domestic demand, and guess what? There is no domestic demand because domestic demand in China is based on demand from the rest of the world. When the rest of the world buys things, they have them manufactured in China, and that means people work. And right now, they know their economy is being propped up by the government, and the United States is now the tipping point as China's manufacturing sector bolstered by robust foreign demand and favorable government policy. Well, I don't know about the robust foreign demand, has powered the country's recovery this year, but exports returned to growth in April. The question now remains, how long can they continue to dump their cheap exports around the world? But consumer prices remain sluggish and credit shrink for the first time since 2005. And when you have credit shrink in a debt-based economy, it tells you domestic demand is not there, and that means their economy is contracting, headed into recession, likely an all-out financial crisis that will spread across the world at a time when companies like Tesla will have record amounts of inventory and be forced to slash prices. The notion of inflation is coming back is that of only a fantasy of central bankers. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.